Howdy everybody, I'm Gary and this is GLoPersonalFinance, where I talk about getting your finances under control, building wealth, and becoming financially independent. In the previous two videos, we talked about one of the main calculations to do when buying a property, the cash-on-cash analysis. And we also talked about how the hidden gem of equity can also add to your wealth. However, with all that accumulation of wealth, Uncle Sam needs to come by and take his cut of the profits. This is why a rental property is so powerful in shielding you from Uncle Sam's invisible tax hand. So I'm going to go through the best tax write-offs when investing in real estate. Obviously, you'll need to consult your tax professional or CPA about these tax write-offs. However, it's great to be knowledgeable about these various write-offs. Now with that said, let's go ahead and get started. First off, the mortgage interest deduction write-off. When you own a rental property, the interest you're charged by the bank is an expense you have against your property. So that can be used to reduce your taxable income. So you got $900 in rental income for the month. However, you had a loan from the bank that charged you $400 in interest for that same month. Good thing for you, since you were able to deduct that $300 in interest, Uncle Sam doesn't know you made $900 in income. Uncle Sam only sees you made $600 in rental income. Heck, any expense you made on the benefit of your rental property is an expense you can deduct. The microwave broke on your rental property? Buy a $100 microwave and deduct that off your income. You drove to Target to get that microwave? Deduct that $20 in gas money you used to install the microwave at your rental property. Practically almost any expense you did for the benefit of your rental property, it can be deducted. So given, for the most part, most people are in the 24% tax bracket. If you didn't have these deductions, you would be paying 24% of $900, meaning you would pay Uncle Sam $216 of your hard-earned money. But given you were able to deduct the $300 interest, that $100 microwave that you need to buy in anyways, and the $20 gas, Uncle Sam only sees you made $480, meaning you only have to pay $115 in taxes on your property. And that tax savings is money in your pocket. Second is the property tax write-off. Property tax is another expense you have. Say you pay $200 per month in property taxes for your rental property, that's an additional expense. So to go off our last example, of the $900 rental income you get $300 off your mortgage interest, $100 off your microwave, $20 in gas, and now $200 in property taxes. Uncle Sam only sees you made $280 this month in rental income. So you're only paying $67 in taxes. The third best write-off is the depreciation of the property. Now it gets a little complicated from here, but essentially what this means is you can essentially depreciate the cost of your house over 27.5 years. So what that means is, say you bought the house for $90,000, you can deduct an additional $272 a month off your rental income. So if you're keeping track from the previous expenses, from your $900 rental income, you get $300 off your mortgage interest, $100 off the microwave, $20 in gas, $200 in property taxes, and now $272 in depreciation. You're effectively only paying taxes on $8. Yeah, $8. Instead of being taxed on the whole $900. The only problem with depreciation is your tax basis will change. So since you bought this house for $90,000 and at the time of selling the property it appreciated to $100,000, if you didn't claim depreciation, you would have only paid taxes on the $10,000 of gains. But say you've claimed $5,000 in depreciation, your tax basis is now $85,000 and you would have to pay gains of $15,000. This is actually beneficial to you because taxes on the sale of a home is way cheaper than rental income. In general, taxable earned income is taxed way higher than capital gains tax. You gotta look that up though. The last best tax savings is the 1031 exchange. Now I still haven't wrapped my head around this concept, but essentially it means any gains you had from the sale of your home, you can buy another property of similar or greater value and you won't have to pay taxes on any of the gains that you just made. Instead, you're just deferring your taxes and putting it into a new property. You will eventually have to pay these taxes, but just at a later date. I still have a lot of research to do on this, and it doesn't work for all rental investments. So having close contact with your CPA or tax person is essential. And lastly, rental income is not taxed as self-employment income, meaning you don't need to pay FICA or self-employment tax. Obviously, there are different types of rental investors out there, so it could change if you are an S-Corp or an LLC, but in general, an individual investor, you won't be paying these taxes. It gets complicated here, so talk with a CPA or tax professional about your individual tax situation. Every rental investor is different. I hope you all learned something from my 3-part series of what I look for when becoming a rental property investor. Not all rental properties are a good deal, so showing you how I do my due diligence only adds to my return on investments while also minimizing risk. Stay tuned and follow me as I bring you along with me while I search for my perfect rental property. For those of you following, I'll be going back to posting more videos on personal finance strategies. Building wealth is a journey. It doesn't happen overnight. I hope you guys learned a lot from these 3 videos. Stay safe out there, and I'll see y'all later.